Investing usually means buying a piece of a company and holding it for years, but if you step into active trading, the timeline shrinks. You're watching price movements that happen in a few days, a few hours, or even a few minutes. It is fast, noisy, and highly volatile. You might already know the basic vocabulary, what a stock is or what the bid and ask mean, but knowing the words doesn't protect you from the chaos. If you want to survive the short-term market, you need a strict, repeatable workflow. We use a 9-point pre-trade checklist. This document forces you to answer specific questions about the company, the market environment, and your own risk limits before you ever press the buy button. Consistently making money in the market does not come from having a magic formula that predicts tomorrow's prices. It comes from executing a flawless, emotionally detached process that keeps you safe when you are wrong. Step 1 is defining your timeline. An investor looks at a business and asks, will this be worth more in 5 years? A trader looks at a stock and asks, can I buy here and sell higher soon? You must choose one approach per trade and stick to it. Many beginners buy a stock for a quick trade, watch the price drop, and suddenly decide they are a long-term investor, so they don't have to take a loss. That is pure denial. To avoid that trap, every short-term trade requires a real-world catalyst. A catalyst is the actual event causing buyers and sellers to aggressively change the price right now. This chart shows an energy stock surging. A green callout identifies the catalyst: geopolitical conflict pressuring oil supply. Now we zoom out to the broader sector. The entire energy market is trending upward alongside our stock, pulled up by a macro event affecting the industry. Contrast that with buying a stock simply because people online are posting rocket emojis or because a chart looks like it's pointing up. If you cannot point to a specific news event, earnings report, or market shift, you don't have a thesis. Waiting for a verified, logical reason to enter the market strips the emotion out of the decision. You are no longer gambling on a feeling. You are executing a calculated position based on real-world data. But a good story isn't enough. You still need proof that the rest of the market agrees with you and is putting money on the table. This chart shows underlying participation. Massive green volume bars align with the price spike, meaning large institutions are trading. Next, check liquidity. The order book shows a tight bid-ask spread, meaning you can easily buy and sell without losing money to a massive price gap. If a stock has low volume and a wide bid-ask spread, it is illiquid. You might buy in successfully, but when you want to exit, there may be no buyers left, and you get trapped holding the shares. Strong volume proves the move. Tight liquidity guarantees your escape. These metrics are mandatory requirements before your money enters the market. With catalyst, volume, and liquidity confirmed, run the setup through the 9-point checklist. Verify the sector strength, define your risk, and check your mental state. Establish an exact entry and exit price. This phase requires absolute focus. Block out the noise of other traders, financial news, and your own greed. Our trade encounters friction. The price dips, but volume remains stable. Checking the catalyst, oil supply pressure remains high. This is just market noise. However, if the conflict suddenly resolves and the price violently breaks through your defined risk level, the catalyst is gone. You exit immediately. There is no negotiation. Professional traders accept when they are wrong, take the calculated loss, and move on to the next opportunity. An amateur will stare at that same broken thesis, hold the stock, average down, and pray that the market eventually bails them out. That behavior destroys accounts. Executing and managing a trade is an exercise in risk management and emotional control. Reading the chart only gets you into the room. Your discipline keeps you there. Let's review the steps. You define your time frame. You identify a real-world catalyst. You verify the move with volume and liquidity. And you pass every item on your checklist before entering. This structured workflow is the barrier between your capital and your emotions. It stops you from buying a stock just because it looks like it's going up, and it stops you from holding on to a loser out of pride. Your next step is to print the 9-point checklist and build a watch list. Pick 5 liquid stocks with clear catalysts. Watch how they move this week and track their reactions to news without committing a single dollar of real money. The goal is to trade the data, ignore the hype, and master the process. Once you can do that, the market stops being a casino and becomes a system you can navigate.